Hello, thank you so much for joining us today. This is Dave Mantel with Stabler Wealth Management. And today's presentation, I can't believe we're already in November, is a year-end tax savings moves for Boeing professionals. This is always a critical topic. We talk a lot about it's not just what you earn, but what you keep that matters from your investments. And so we're going to go over some of the key tax saving strategies to really hone in on and look to get in before the end of the year. All right, so with that, looks like we're ready to go. So I will share my screen and we will dive in. Okay, perfect. So year-end tax savings moves for Boeing professionals. Why are we doing this presentation? We always like to start with. And so as we're at the year end of 2025, couple things to outline and start off with that. First off, these last months of a year is sort of that last opportunity to action things that'll impact your 2025 tax bill, of course. There's certain things like regular Roth contributions, IRA contributions that drip into the following year. Even tax payments you have until January 15th. But we're going to go over some items, especially as a Boeing professional, that have that year-end timestamp on it that it needs to be completed by. Uh, from there, as I noted, it's not just what you earn on your investments, but what you keep. And for Boeing professionals, we've seen case in case, you could save thousands of dollars with small year-end adjustments that build and accrue over time. And so this definitely moves the needle on your financial picture and overall retirement picture. So something really important to key in on. And then with that, we had some pretty substantial tax changes earlier this year. The big, beautiful bill, I'll just refer to it as a big bill, as I know it's quite a mouthful, was passed earlier this year. And it did have some pretty, major adjustments. And more than anything, locked in some favorable aspects to the current tax picture. And so we'll go over exactly what that means for your tax plan and what we should be doing or considering doing as a result of that. And I'll talk about this a little bit more in the presentation, but remember with tax laws, nothing is ever permanent. Even when, they talk about, hey, we made these tax rates permanent or this or that, it's just permanent until the next political regime, makes an adjustment, right? As we've seen time and time again. And so whenever we're looking at tax planning, we want to have a focus on, yes, what are the rules today? What should we be doing? But we also want that lens in terms of what is lasting for the future. And so I'll go over some examples of this as we get into the presentation. Okay, very good. Before we dive in, quickly, a little bit about us. Here at Stabler Wealth Management, we're a team of certified financial planners, CFPs, that specialize in working with Boeing employees and helping with that transition to retirement. As CFPs, we're fiduciaries, which we view as really critical for any financial planner advisors that you consider working with. And our whole thing is, applying personalized advice where we know the ins and outs of a Boeing plan, but more so, we learn how to apply that to your own goals and financial picture. So we do these webinars regularly. We have monthly articles that go out, a lot of good information. And so go to our website. We have a short page, planyourboeingretirement.com, that will take you right to that Boeing content. But make sure to continue to tune in for these webinars, but other information that we put out there as well. Okay, very good. All right, so as we go over year-end tax planning strategies, we're going to count down a bit, starting with some of the high priority ones that we should be doing this year. And I'm going to start with, an oldie but goodie, right? We've all heard this, from us and others time and time again. But maximizing your 401k is really the bread and butter of retirement planning and building up that retirement nest egg. And so going into the numbers a bit, so in 2025, you can contribute 23,500 for the year. If you're age 50 or above, another 7,500, so 31,000 total, into either your pre-tax 401k, your Roth 401k, or a combination. Real quick, many of you know this, but again, the pre-tax, when you put money in, it reduces your taxable income today. So you save taxes currently. The account grows without tax, but when you take the money out, every dollar is taxed as ordinary income. With the Roth, the money you put in today, you don't get any tax savings on, but all the growth is tax free, including when you take it out, if done appropriately. And so the question is, are you going to be in a higher tax bracket today or tomorrow, right? Is what we want to be thinking about. And I'll provide a little bit more color on that. A newer rule, so starting this year, if you're between ages of 60 and 63, you can do the super catch up. So rather than 7,500 extra, you could do $11,250 extra. This is the age that you end the year in. So if you turned 60 in March this year or December this year, you still apply. If you're 63 but turn 64 on December 31st, then you don't qualify. You got to do the regular catch up. So this is a new wrinkle that for folks in that age range does allow you to save more. So that's always a good thing. I jumped the gun a little bit, talked about Roth versus pre-tax contributions depending on your 2025 tax bracket. Um, and on top of that, you can have your cake and eat it too a little bit. So, for example, you may say, hey, I'm in my higher earning years. I want to do the full pre-tax contribution, whether it's 31,000 or, higher with the super catch up, depending on your age. With Boeing, they have the after-tax 401k program. We deem it the Mega Backdoor Roth that allows you to put an approximate additional 25,000 into your 401k on top of those regular contributions. And this additional 25,000 has to go into the Roth category essentially via after tax. And so what that means is if you're in a position to do the Mega Backdoor Roth, you might do the 31,000 or whatnot into the pre-tax bucket and then do the extra 25,000 in Roth. So you sort of get the best of both worlds. So that's a popular one. Whenever I talk about Mega Backdoor Roth, you need to execute with precision on this. So it's not a matter of, oh, I'm going to put the extra 25,000 in my after tax, I'm good to go. You need to get that from after tax to your Roth for it to be effective. And so you need to correctly roll that. And the way that it works, the best practice for doing that is to roll it to an outside 401k. You're from your 401k to an outside Roth IRA vehicle. And the reason is if you convert it from after tax to Roth inside your 401k, then the gains that you've had to date in the after tax will become taxable at that time. And so, for example, let's say last year you put 25,000 in the after tax Mega Backdoor Roth, and you haven't converted it or rolled it to Roth yet. If that 25,000 grew to 30,000 and you convert it to Roth inside your 401k, the 5,000 in gain will be taxed as ordinary income at that point. If you roll it to an outside Roth vehicle, the 25,000 contribution would go to Roth, the 5,000 gain would go to a regular IRA, and so you could defer the taxes on that gain piece. There is a way to call Boeing and ask them to just convert it right away, which could make sense in certain situations. But commonly, most people that we meet with, new folks that we talk to at Boeing have some after-tax balance already in their 401k. And so you just want to be really careful to not trigger an unintended tax impact. And so again, it's good to get into a mechanism where you're able to roll that to your Roth IRA regularly in a thoughtful way. Yeah, just to kind of add on this, some of you may be saying, I'm doing my regular 401k, but another 25,000. Are you kidding me? 31,000 is already a lot to save. How am I going to save, 55, 56,000 a year? Remember, this is contributions. It's not necessarily savings that you need to do. And what I mean by that is if you have like some brokerage account money or extra savings or CDs or cash, you can put extra in the 401k through the Mega Backdoor Roth and then repay yourself from those other accounts that are less tax advantageous. So you have enough cash flow hitting your bank each period. So again, not everyone, I'd probably say most people, be hard pressed to save 55,000 or more each year. Um, and so if you're not in a position to, we could still potentially use up those tax advantage by sort of reshuffling your other accounts and where we're saving your cash flow. Okay. So again, 401k, Mega Backdoor Roth. I know I've talked about it, dozens of times, but this is the bread and butter. And this, if you do it the right way, you're intentional, you do it over a number of years, even, a handful of years heading into retirement, this is absolute game changer. Okay, so we'll start there. Okay, good. The 401k gets all the attention. Strategy two, don't forget the HSA, the health savings account. While this one's a lot smaller in stature, it definitely, punches above its weight where with the health savings account, you get the best of both worlds. The money you put in, you save on taxes today, it comes off your income. The gains are tax free. And then you could take out everything without tax as well, as long as it's used for eligible, health related expenses. You're going to have an opportunity to use it. It could be used for Medicare premiums once you're 65, for example. And so a lot of times, we'll view this as sort of a complement to your Roth or other savings accounts. And so it could be very powerful. The amounts for you 2025 you could do. So if as a family, you could do $8,550. The individual is approximately half that. And if you're 55 or older, so different than 401k that has an age 50 catch up, it's 55 for the HSA, then you can do an extra $1,000 for the family or for the individual. To be able to do the health savings account, you have to be in a high deductible health plan. So basically means you have to be on the Advantage Plus plan. And if you do, the good news there is Boeing actually contributes to your HSA as well. I do want to outline the 2025 limits I shown include Boeing's contribution. So for example, if you're on the family plan, you're age 55, you could do 9,550. Boeing's putting in $1,600 already. So that leaves, just under $8,000 that you can contribute for your family on your own. All right. And yeah, as I alluded to, we typically like to treat this as another retirement investment vehicle, not just for current expenses. Because again, a lot of people will put money in here and just pull it out right away. What's better, especially if you have the cash flow to cover your health needs elsewhere, is hey, why don't we grow it tax free? In which case, the gains you don't pay tax on. So that's better than a regular 401k, for example, a pre-tax 401k. So, yeah, sort of our favorite. You could actually contribute this to this up to age 65, even if you're no longer working, until you go on Medicare, as long as you're in a high deductible health plan. And so commonly, while folks keep contributing to this, even up until 65, at least until retirement, we could invest it for growth. And then come age 65, boom, all your Medicare health insurance premiums could be paid for using this. So you don't have a new expense that you have to come up with out of pocket, right? You've already earmarked funds for it. And so, yeah, we've seen in many cases with clients, we'll build this into a six figures account, which really sets you up well in retirement for health insurance expenses. So small, but one of my favorites. Okay. So Roth conversions, this has been a buzzword for a number of years. And a lot of times, the playbook is, okay, I'm going to retire. In my early retirement years, maybe my taxes are lower. I haven't started Social Security yet. So I'm going to convert money from 401k or IRA pre-tax to Roth, pay the tax then at a lower tax rate. What's interesting is we're seeing a lot of use cases where this could make sense to do while you're working. Okay. So first things first, we have very low tax rates. Part of that big, beautiful bill, the big bill, is that they extended the current tax rates that are quite low. And the way you win on a Roth conversion is if the tax rate you pay when you convert it to Roth is lower or even equal in a lot of cases to the tax rate you'll be in when you spend that money, you or your kids down the line. And like I noted, tax laws are never permanent, right? And so the fact that we have really favorable tax rates right now commonly, can make it a good time to convert that money and get it protected. So, for example, using up the more favorable 22 or 24% federal ordinary income tax brackets could be a good move. The other kicker is it's not just, hey, year in, year out, here's what my income's going to be in retirement, here's my tax rate. The Roth can build flexibility where if you have a higher expense year, you want to give money to your adult children to help with a down payment, or you want to renovate the kitchen, or whatever it may be. If all your money's in a pre-tax 401k or IRA, oh, I got a big 200,000 extra expense this year. Now I'm in the 32% bracket, or whatever it might land at. And so what's great is having that Roth bucket available is you are able to use that, intentionally down the road, again, kind of with a precision approach to keep you out of a higher tax bracket. So we're always a fan of that. Also, that gives us a little bit more flexibility on how to invest in various accounts, investment location, which we've talked about before. And yeah, as I noted, the big bill extended today's current favorable tax rates. Tax laws are never forever, right? So again, it gives us a longer window to be looking at these Roth conversions. So again, to kind of recap this slide here, a lot of times while you're working could be a good time to do Roth conversions if you don't have a lot of tax diversification and you have all your net worth tied up in a 401k pre-tax, for example. It could be really reasonable to do Roth conversions at a 22 or 24% rate to give yourself more of that future flexibility, especially as you fast forward down the years where you have Social Security, possibly pension, required minimum distributions, required draws on your retirement accounts in your 70s. Uh, Once you're on Medicare, you're age 65, there's another tax. It's a medical insurance premium surcharge called IRMA. But basically, as your taxable income's higher, your gross income, that could spur additional charges there too. So it just gives you a lot of, lifetime tax planning flexibility. So I'd say for anybody who's kind of nodding their head as I'm laying out some of the scenarios where most of your savings is in a pre-tax 401k, this would be a good time to chat and we could go over this with you to see, hey, should I do a Roth conversion this year? Does that make sense for my picture? And next year, as well, and the following year potentially, right? But we still have time to look at possibly doing that before year end. Okay, good. Okay, strategy number 4. This has become an interesting one. Those that are charitably inclined, especially with the big bill. There's been some changes in strategies to be looking at here. First things first, since 2017, we have been limited at on your tax return to itemize only $10,000 of property tax, state income tax. So if your property taxes are $12,000, you can deduct 10,000. That's the limit. The trade-off is we have a higher standard deduction now, but nonetheless, especially if you're in a state with a state income tax, it's been a good adjustment where you can now deduct $40,000 of state and local taxes from your taxable income. So again, upping it from 10,000 to 40,000. If you sell a house and you're like in a higher income year, so if your income's over 500,000 for a certain year, that higher deduction phases out or phases down. But generally speaking, this is available for the coming years as another tax deduction tool. Um, And by the way, what that means is some people may be itemizing that we're taking the standard deduction before. Okay, as we look forward to 2026 and beyond, a couple charitable adjustments. One, next year, you can deduct $2,000 from your taxable income for charitable giving, so up to $2,000, even if you don't itemize. So you could take the standard deduction and still deduct a $2,000 charitable gift on top of that. So that's, again, good news there. The new rule does remove your tax deduction on the first 0.5% of charitable gifts that you do. So if you gift $10,000 to charity, the first $500 you don't get a deduction for starting next year. That's not the case this year. And so with this combination of changes for charitable giving, let's say you give $10,000 a year to charity. That's your thing. There's a couple techniques to look at. One, bunching is still applies. And what bunching means is you're going to pick certain years where you're going to itemize your deductions and certain years where you're going to take the standard deduction. And so in a year where you're going to itemize, you might say, hey, I'm going to give $40,000 to charity this year. I'm able to deduct, more of my property tax, state income tax as well, if applicable. So this is going to be an itemizing year. And then next year, I'm not going to take a tax deduction for charitable giving and do the standard deduction. So that's a good approach. You may say, well, I'd like to do my $10,000 a year to charities. I don't want to do $40,000 and then skip 3 years and do another 40. One of our favorite tools on that's called a donor advised fund, which basically allows you to set up another charitable account. It's like your own mini little foundation, but it looks just like another investment account along with your others. When you contribute to that, that's the time of the charitable gift. So you get the $40,000 tax deduction, that example I gave, and then you could disperse it to the charities over time as you desire. So this is a really nice way to kind of maximize or time your giving in that regard. I know we're already in November and you might be trying to wrap your head around this. This is actually a reasonable year to contribute to the donor advised fund. One, this year they don't have that 0.5% of charitable giving that you don't get the deduction for. Also, the stock market's done really well. And one of the best things about a donor advised fund is you could gift appreciated stock. So in addition to getting a tax deduction on the gift amount, you also avoid capital gains. But the stars have aligned a little bit, creating some good techniques for charitable giving. And if you're near retirement, we also want to parlay this with your retirement tax planning also, because it gives a couple more tools in the toolkit to consider. So again, if if you're charitably inclined, a couple techniques to be thinking about. Okay, great. All right. So with that in mind, strategy number 5, nobody likes year-end tax surprise. And the good news is you don't have to have one. So whenever we do tax planning for folks, we like to start with 2 documents. One, last year's tax return. I know year to year it changes, but it's great to use that as a starting point so we could then run a projection for the current year based off of that. The second item is it's great to get a recent pay stub that shows, your income so far this year, how much you paid towards taxes, 401k contribution deductions, things like that. So always recommend getting those documents handy. And with that, we got a lot we can do. So what we like to do in addition to deciding what tax planning opportunities we have this year, some of the strategies we've gone over so far, that also allows us to look at how you're sitting tax payment wise. And you have until January 15th to make an estimated tax payment to avoid underpayment penalties. So it's a good time for you to grab your pay stub, run an analysis, see where you stand. And that way you have 2 months if you are short on tax payments, even if it's a little too late to adjust your tax withholding to avoid an underpayment penalty. I do want to note a number of folks we work with and have met with more recently, as they've tried to add tax diversification to their picture, they've actually been adjusting a lot of their 401k contributions from pre-tax to Roth. And with that, that does mean you have more taxable income this year as, the Roth saves you future taxes, right? Not today's taxes so much. So if that is something that can sneak up on you a bit, is if you made that change yourself, good time to run that pay stub analysis, as I mentioned, to assure that you're not setting yourself up for a tax surprise. Okay, great. So, those are a handful of strategies to be looking at and going through that list right now and seeing what applies for you while we still have some time. As we look forward to 2026 and beyond, a couple of things to highlight with the tax law changes. So, the big bill, that SALT increase, so again, state and local tax, including property tax deduction, the cap increasing to 40,000 goes through 2029. Um, As I noted, while some of the extensions, like the lower tax rates, are made permanent, same thing goes for a state tax exemption. They're not really permanent, right? Because, they could change the next time we have a new political regime. And so it's good to proactively plan now for the years ahead, while we have the current, tax rules that we know how to handle and deal with, because they likely will change at some point down the road. The only constant is change, right? And then I do really want to highlight, for those that do not qualify for Boeing early retirement health insurance. So again, I believe if you're SPIA, that means you were last hired before 2007 and have consecutively been full time with Boeing up until your retirement. For non-SPIA, I believe in most cases it's last hired before 1999. So as the years go on, we're talking to more and more people that don't qualify for that. Planning today is absolutely crucial. Even if you don't have Boeing early retirement health insurance, you don't have to work until 65 Medicare, but you got to plan, because it's a lot more nuanced trying to bridge that early retirement health insurance until 65. So everything I went over also can set up really well with shaving some years off your retirement if you're in that situation. So yeah, if you don't qualify for the Boeing early retirement medical, I definitely reach out to us and let's see what we should be doing starting today to plan for that. Okay. So year-end action plan, recap, confirm your 401k, health savings account, Roth contributions. Consider a Roth conversion today to save taxes tomorrow. Again, even if you're still working, that could very well apply. Navigate the new big bill uh, tax changes there, and utilizing the favorable tax rates while they're available. And yeah, it's not too late. So yeah, set up a year-end strategy review to work through all this. We're in the back half of November now, so it's a good time to put aside some time to map out that strategy game plan for you. Okay. Yeah, so we covered a lot of good action steps. I'm sure many of you are, following along and have your marching orders. For a few of you, you might say, gosh, this all sounds great, but I don't have time to do this. Nor do I have the desire. I'd rather spend my weekends doing something else. And probably some of you have been nodding your head, but, it'd feel good to have a partner working through all this stuff. And so, as we've done in the past, we offer a free second opinion on your retirement plan. So please reach out today. Let's get that set up, sooner rather than later, and we could go through a lot of these strategies together. The way to set that up is you go to our website. You can go to planyourboeingretirement.com or stablerwealthmanagement.com. Big orange button on the top right that says Let's Talk. So that will set you on my calendar, and then we can map out how our firm can best help you, as well as set up that free retirement review with you. So yeah, I really encourage you to take the time and do that. We'll be doing more of these webinars, seminars in the future. We used to do these in person as well, and I'm itching to do so. And so let me know if that's something you'd show up to or be interested in. In the meantime, we'll keep the webinars and articles going. And if there's any topics that are of interest to you, please let us know and we'll make sure to cover that. So yeah, again, thank you for joining us for our presentation. I hope you found this helpful. Looking forward to talking to many of you, and have a great holiday season. So thank you so much for joining. Have a great rest of your day.